Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
It's Monday, November 12th, 2018. Welcome to the podcast. Hope you had a good weekend. Mine was spent being Sherpa dad, the suburban Sherpa that I am. I always joke, and I spend the weekend, I'm sure as many of you do, shuffling kids around town from one place to the next, going to pick up things, whether it's, somebody forgot something, somebody needs something dropped off, and driving around. And I realized how much time you actually spend in the car, just doing those. And I love it. I love taking the kids wherever they got to go, and I'm happy at any time. But I was joking with my wife the other night. I said, on any given evening, I could be out 3 or 4 separate occasions, which is good actually, because I never drink beer or wine anymore. I didn't drink a lot, but I'm certainly not going to have a beer or wine if I know that I'm on call to go pick up the kids somewhere. So that's good. So that it's I don't have to have that extra beer, extra calories or so from that. But aside that, so last week I was talking about the Islanders and how I was excited. They reeled off 5 in a row and they hadn't won the cup since '84 and yada yada. And I got blasted on Twitter in good nature, people saying like, you're out of your mind. So not too long after I did the podcast, I'm on my spin bike at home and I'm watching the NHL Network while I'm riding, and they come up and they say, "Are the Islanders for real?" They do an episode and everyone's like, "Not a chance." I'm like, "Yeah, well, I get that." And they've lost 3 in a row, right? But this is a pattern with me when it comes to, and you've heard me say it, New York professional sports teams. It's misery. It's absolute misery. Back in April, I waited. The Mets were 11-0, 11-0. And I waited because being a Met fan, you're going to be disappointed. And I came out on a podcast and I said, folks, the Mets look like they're real. And they finished like with the 2nd or 3rd worst record in the National League. They were a disaster. And same thing with football. And I'm a Jets fan. Last won the Super Bowl in 1969. We still hold on to our Joe Namath memories. For those of you who remember Joe Namath, Broadway Joe Willie White Shoes, he's a legend around here still, because we've had nothing in 50 years to talk about. Right? I keep a signed autographed football of him in my office, and when people come in, they're like, "Wow, Joe Namath." And it's been that long since we've had something to talk about. But they drafted Sam Darnold, and he came out and he had a monster night on Monday Night Football, and I came out and I said, okay. And then the season wore on. I dusted off my Jets gear, my sweatshirt, my fleece, got the hat. They lost to what was the worst team in football yesterday, 41-7, I think it was. I turned it off. The Buffalo Bills ran over. The Buffalo Bills looked like the Patriots running at full tilt. I mean, it was an unmitigated disaster. It's crazy. So I sent a group text to my buddies that on this day, the 11th of November, 2018, I am officially divorcing the New York Jets. I am a man in search of an NFL football team. And I might go CFL. I can't do it anymore. I just cannot do it. You try, they tease you, and then and they pull off an unmitigated disaster like that. So Islanders, Jets, Mets, you've heard me talk about it. I'm sure you fast forward through this, but for me, this is therapeutic, right? As a New York professional sports fan, this is my therapy. Now that I've done 36 podcasts, I realized that I could talk about it for 5 minutes and I feel better. Okay, there you go. I feel better. So, interesting week. Last week I talked on the podcast about midterm elections coming up, and who knew what would happen. But the market was just wants to know something, and we got the split. Right, it produced a split Congress here in the U.S. The Democrats took control of the House, the Republicans retained control of the Senate, and really the market was thinking, okay, here we go. We have a newly divided Congress. And probably preserve some market-friendly policies, namely the tax cut and dereg efforts. But the market also kind of looks back, right, and says, okay, how did it do in prior years? And it's done well with the Republican president, a split Congress, right? So, hey, when you're 10 years into a bull market, the market's looking. Let's reach. Let's look. Let's go back and find examples. And the S&P was up a couple percent, I think, on the week. The Nasdaq was up almost 3%. And the Russell, the broader index, was up a little bit. But later in the week, I think it was Thursday, the Fed came out and they said, their policy statement, and they didn't raise rates. The Fed funds, they kept them unchanged, but that was kind of expected. But they did note that you're going to see further rate hikes, which happens with economic growth. You've got a pretty good labor market. Not pretty good. You got a really strong labor market. Inflation's inching up near its 2-year 2% target, right, over the medium term. But was interesting, and I think the market wanted to see it, was the Fed. It's what they didn't say. They didn't talk about the October market sell-off, and they didn't talk about U.S.-China trade developments in the policy statements, right? So if you were trying to read between the lines, what you might take away from that is they're still going to raise rates, right? And so, again, here we are. The market typically doesn't like rising rates. So that wasn't met with great fanfare. But we'll see where it goes from here. And you've heard me say it. I'm not going to get into it again over and over and over again. Just I think now's the time to be cautious. So, but when it comes to that, if you take all that stuff aside, I think if you are a new listener, you don't know this, but if you're an existing listener, you know that I like to toil in the underbelly of the market on the long side. I like to focus on things that are down and out, things that have been left for dead, things where there's not a lot of eyeballs on it, rather than playing this game, right? What was the Fed thinking? What's the market thinking? What's going to happen? How can the overall market, right? If I'm involved in a lot of the names in the overall market, what's looking for more secular type names. I don't. I personally like names that have been shot. And in there, you'll once in a while find some value. And I think you do find value because it's very difficult to get investment edge, if you will, and informational edge. When something's popular, when somebody's focused on it, when a lot of eyeballs are on it, on the margin, a lot of that gets priced in. You know how people say the market is pretty efficient? Well, it's not totally efficient, thank God. But there are, for more mainstream stuff, there is. And I've brought you guests that are, I like to bring guests that don't think mainstream names. Neil Weiner comes to mind, a friend of mine who I had on a few weeks ago who is he's focused more on distressed investments, right? So that I like to look in the underbelly and things that have been that are not doing well, and so that's where I look when I'm looking for my information. I'm not reading the I couldn't really tell you. I know what Google and Facebook and Amazon do, and I read a few things here and there, but that's about it. Same thing with mainstream names. If I'm somewhere talking to some friends who are not in the business and they want to talk about something that's pretty mainstream, my views, like anyone else's, probably. So I don't participate in the market, if you will. I take my investing skill set and put it into things that are away from the market, but are typically publicly traded equities. So one of the platforms that I think is interesting I mean, I read all sorts of funky stuff. I'm not reading mainstream financial press. I'll glance at the headlines, but it's the same. They're all the same, right? I guess one looks at the other, and it's whatever is popular gets picked up there. I don't watch the TV programs during the day. You've heard me say that before. I don't watch the experts sit around on a dais on a 1 hour program talking about what's hot, what's not, what's going to work, what's not going to work. I don't watch a program where somebody stands up there and has rounds where people call in and they have an opinion on every name and they know it. And no, thank you. So I read a lot of geopolitical stuff. I read a lot of foreign policy stuff, a lot of natural resource stuff. And you've heard me say before, if you're a listener, that I like the resource space because extreme highs and lows, supply and demand, and human nature and psychology takes over. And I love the psychological aspect of investing, right? There's a school of investing thought called behavioral finance, because the market is made up. Investing is made up of buyers and sellers who are human beings. Now, yes, I know there's quants and computers, and that's made it harder and harder and harder, right? Because they work off of algorithms. But they're not focusing on the things that are dead and buried, that are left for dead, that are on the trash pile. They'll catch those when they're working, right? Those algos will pick up those momentum signals that's going on. So I like to kind of find them when they're not. But oftentimes in these deeply, deeply cyclical industries, you kind of just forget about them, or you lose faith in them if they're down and out. But as long as they serve something, they extract something from the ground that sells into a market that needs it. It's a supply and demand business, and it kind of comes down to fourth grade math. You may have heard me talk about that before. It's one of the things I like about the uranium mining industry and the nuclear power industry, which has been mired in this really long market. But at the end of the day, if you could capture all your sources of supply, all your sources of demand, and not a lot of people are looking at it or focusing on it or disbelieving of it because it's been so long, and they may have heard the story before, right? And they may have heard the story when it was more mainstream, right? When something's been really working for a long time, they get a lot of sell-side analysts following it, a lot of institutional ownership following something, and then it disappoints. And when it disappoints, people are somewhat defensive of those positions that they own and their stances, right? There's that public bias, so they'll come out and defend, and they'll defend, and then all of a sudden, as time wears on, and it becomes more obvious that work needs to be done on if it's a long, let's say, and there's too much supply, and as time grinds on, people's patience wane, and then some have averaged down, but then some people, you just get to a point sometimes where you say, no mas, I can't do this anymore, I'm out. And then it takes time, right? It takes supplier discipline when you're looking at an industry that's deeply cyclical. It takes the suppliers to feel pain, to feel profits evaporate, to catch the ire of shareholders. And then what they make, what they're producing, what they're extracting from the ground, what they're making, they need to make less of, right? You need to try and bring a market into balance, at least if there's too much of something. And because your goal is to take out supply from the market. So the customers who need it are going to have to pay more, right? It's just so simple a concept. And then you have to look at how much inventory is sitting out there, right? So if I have supply and demand and I cut supply, well, how much inventory could I draw down? And then, but when markets are in deep, deep, deep bear markets, it's easy to look at a number like that and say, well, God, look at that number. And if a lot of people aren't, it's big. If a lot of people aren't paying attention to it, right, it's pretty easy. Then it's exciting. You can go dissect that and say, is there anything here that's being taken for granted? Is this number is this inventory number that everyone uses as its benchmark, as the number they bandy about? How's it composed? What's it comprised of? Right? And you'd be surprised how at times it's much different than that, and we see that in the nuclear fuel and uranium industry. At least I believe so now. And again, I'm not going to get into the whole. I talk enough about that, but that's the world of investing that I like. So if you're a podcast listener here, and by the way, it's much less popular. So and I don't do the podcast for popularity to get listeners. If you listen now, if you stumbled upon this now, that's kind of what I do. If you're a regular listener and you've been able to survive my ridiculous sports rants in the openings, you might have an interest in natural resources. But so I don't listen to the mainstream. I kind of go off on my own. I kind of do my own little thing. I kind of like the desolate world that is. And I look at different stuff. One of the things I do is Twitter. I'm on Twitter, and I wasn't for a year. I joined in 2009, but I never used it till maybe year and almost 2 years now. I started posting a few things on uranium, and I'm at footnotes first is my, I don't know what they call it, my handle. I don't even know where it is. And over time, right, I've become much more of an observer than a poster. I don't post about individual companies. I post about my views pretty typically either on nuclear power, uranium, or Tesla. That's my what's your hobby? Tesla. But I learned how to extract really great value from the platform, the FinTwit, finance Twitter. There's some really, really smart people on there. And I love the fact that you don't have to know who they are. My name's out there. It's Mike Alkin at Footnotes First, but many people choose not to put their name on there. Some do it because they're actually just nasty, miserable sons of bitches who like to go after people and troll people and say really miserable things and don't have the balls to put their name out there. And that's one thing. But that's a smaller portion of it. Then there's other people who choose not to do it just because they want to remain anonymous and they just want to post, or maybe their job doesn't allow them to. But one of the things as a professional investor, I could pretty much tell in one tweet if somebody is learned or not about investing, if they understand the business and game of investing. And so a lot of times people will tweet and they'll talk, and then there's different types of people like that, right? So there's those who may be amateurs and do-it-yourself investors who bring biases, they bring anger, they bring frustration, they bring rants, but they may have something really interesting to say. You could tell that they just kind of understand investing. And there are those who are do-it-yourself investors that don't come with the rants, don't come with the anger, but you read their stuff and you could tell, okay, they're good thinkers, right? And if you know my background, if you've heard the podcast before, you probably know I'm not a Harvard or a Wharton educated MBA, right? That's not my educational background. I started out at a big university and I didn't finish there, and I wound up finishing at a local commuter college in Long Island, New York. And the last thing I ever thought was I was going to be a hedge fund guy 20-something years ago. I had no idea. And I was not groomed for it. I didn't aspire to it. It just kind of happened. And along the way, right, so I came into a world that was loaded with folks from the most premier schools in the world the best educations in the world. Many of them decided that that's what they were going to do from the time they were 12 years old. And with their first paper route, with their first money, they went out and bought a stock, right? I didn't know what a stock was probably till I was in my 20s. And that's fantastic. Some brilliant, brilliant people. But what I've learned over the last, for over 3 decades, 20-something years, is that doesn't matter. Most of this stuff is basic math. I mean, some finance concepts you got to learn. Peeling apart a balance sheet and cash flow statement, you got to understand some basic accounting, but common sense. Doing, I always say, 4th grade math: add, subtract, multiply, divide. Understanding causal relationships, understanding supply and demand, understanding human nature. Those things are really what make, I think, a good investor. And having a big set of cojones help too, and having gut instincts, right? So there's ways around it. You don't need to have been a professional investor that went to a top-notch school. If you did, that's great, and you may be a fabulous investor, but it's not a prerequisite. It may be a prerequisite to get into a preeminent hedge fund or investment bank, right? My stories, I wound up at a couple of them, but I didn't start there, and I had some good fortune and really worked on 90, 100 hours a week for a long time once I got in to prove my worth. But I find the Twitter platform very fascinating, where you can meet some extremely smart people who don't do it for a living, who don't bring maybe professional biases to it. And some might, you know who they are, and others you don't. And one of them is, I'm going to bring a guest on today who I read and I think is an interesting guy. And I didn't know anything really about him. And I saw his commentary on the nuclear space and the uranium world, and I thought it was pretty darn interesting. And I thought I wanted to share that with you. Like, here is somebody who doesn't do it for a living. It's caught my attention. I think it's very, very bright. I think has some really good things to add to the conversation about different topics. So I said, you know what? Let me bring him on the podcast. I think it might be interesting for people to hear, because people say, "What do you read? What do you read?" Oh, I read a lot of different things. Where do you get your ideas? I get them a lot of different places. So we're going to take this interview and talk with Hammer Investing. He's at Hammer Investing, and we're going to bring him on and we're going to talk to him about it. And I think it's really going to be an interesting conversation. Jacob Leedgaard, welcome to the podcast.
Well, thanks for having me on, Mike. I appreciate it.
Well, it's great. We've had plenty of exchanges on private messages on Twitter, but this is our first time actually speaking. So it's a pleasure to speak.
Yeah, it's a pleasure for me too. I've been looking forward to it.
I was telling the listeners before you came on just now that I get asked a lot, what do you read? What do you listen to? What do you pay attention to? And I said, well, it's certainly not the mainstream stuff. I mean, I read headlines. So I don't live under a rock and I know what's going on. But really, for me, it's about finding asymmetry and looking for things that are left for dead. And I tend to find those in deeply cyclical industries. And I've always found that that's where you can find some fascinating ideas. And because a lot of it has to do with human nature. And one of the things I was talking about, one of the platforms I use is Twitter, and I like to look for smart people. And I love if they don't have their name out there, and you don't know who they are, but you could tell pretty quickly. I could tell pretty quickly if they're thoughtful, if they're bringing an investor's mind to it. And I started following you many months ago because of uranium, and obviously I have a firm that focuses on nothing but uranium investing and the nuclear fuel cycle, and I saw your stuff, and we started to interact back and forth a little bit, and I reached out to you. You had posted something a week or two ago, and I reached out, and we were going back and forth. And you told me your background, and I said, my God, you have to come on the podcast. This is great stuff. So why don't you share with listeners who you are, what you do, and how you got here?
Yeah, well, thanks, Mike. Well, I got involved with investing at quite a late age, at the age of 35 in 2006. Mm-hmm. By that time, I had been a poker pro for 1 year, and things were going quite well. I was making decent progress and decent money, and I thought, okay, so how can I protect this and perhaps even grow it? And back then, I actually think I was more focused on, taking risk than protecting. And now I've scaled. I've learned my lesson, and you get your head handed to you sometimes by the market.
There's no greater teacher, right, than losses. Yep.
Yeah, and I experienced that a lot in poker too. So you go on a hot streak, and you think you're a gift to the game, a god to the game almost sometimes, and then you come crashing down just a few weeks later. So you learn humbleness from the game, as you do in investing, and what I found to be really important is that you need self-control in the market, not to let your emotions be swayed by Mr. Market. Mm-hmm. And if you read the news, then at the top of a market, it's very euphoric, and everybody wants to get in on it because their neighbor made a lot of money.
Yep.
And so they want it too. Yep. And the same when it goes down, and the headlines are screaming with big types of how the world is falling apart, and people just want to hit that sell button, and I do too. I think it's very normal to want to get out in those situations, and in when everybody says to go in, but after a while you learn that you should do the opposite, and actually almost not trust your gut instincts, and definitely not the headlines.
It's fascinating. I talk, and on Twitter when about a year and a half ago, I think, I presented, I gave a couple of public talks on uranium, and so I guess that attracted people to follow me on Twitter, and there was a handful of guys where every time, and I said you have to have patience and long term and all this stuff, I said it's the best risk reward I've ever seen in my career. But every time uranium would have a couple of tough days, I'd have guys come out of the woodwork saying, "Hey, big guy, hey, dummy," like, and right, and I couldn't explain it in any certain way. I could not care less. I have my long view. This is my view based on numbers and supply and demand. And you focused, Mr. Smartass, on coming out after me on what's happening day to day. That might be your thing. You're trading day to day. That's great. Or you're going to let the price action dictate your conviction, which I think is really stupid to do. So it's interesting, and that's your view is how I view the world. It's euphoria, it's depression, right, when it comes to investing. And I've found that for me, the best, the times I've done my best is when I can pick off that human emotion, which, and you and I were talking about, I had never played poker ever. And I had never played. A lot of my buddies play. And I think I was telling you it was maybe when we were DMing back and forth. It might have been 2, 3, 4 years ago. I forget now. But a friend of mine called up and he said, "Hey, one of our friends in town was hosting a charity poker event at his home, and there were like 70 people coming." And he said, "Come on." And I said, I never played. He said, "Just come on over, and I'll teach you on the way over." That's a 10-minute car ride. So he picked me up and we're driving over, and he gave me like a crash course in poker. And I think we were playing Texas Hold'em. And we sat down. There were a bunch of guys who play a lot. And fast forward, if we started at 7 p.m., by 3 in the morning, it was me and another guy left. And I still don't think I really knew what I was doing, but I realized it was risk. I had enough of the groundwork. It was risk reward. It was like portfolio management. And it was, it was right. And so obviously beginner's luck. And, but it fascinated me. And when you started telling me about your poker playing, and I have some buddies who are hedge fund managers who play a lot of poker and high stakes poker, and it's and big time poker, and there's so many similarities. So I could see how you can have translated that skill set. And I haven't played since, by the way, but it's fascinating to me. So talk about as you started in your investing, how did you get started? What did you do? Like, how did you say, okay, let me teach myself? Because in your writings, you are writing as though you've been doing this for a long time, right? You understand not just the jargon of investing, but the thought process of investing and the thought process of being contrarian, essentially. And not right there. That if I had to summarize your style, that's what I would say it is. So walk us through how you taught yourself, because a lot this podcast, and I said to you earlier, right? It could have a few thousand or a lot of thousands listening. I said to you offline when we were just speaking, listening every week. The people I don't care if listen to it or not are professional investors. I could not care. I don't do this for them. They know their stuff. I do this for people who are trying to do it themselves, because I see a lot of things, and even now on Twitter, I'll see people post stuff on uranium about stuff where I just say, oh God, no, that's not what you need to be thinking about. Or sending a mainstream thought and saying, look, this guy's really likes it, or this newsletter guy is pounding the table on uranium, or this sell side, they've been doing it for the last 5 years, folks. But so how did you get started? Because you don't write like a guy who just said, let me pick this up. Walk us through that.
So in the beginning, I think I made, I still make mistakes, of course, everyone does. But
I own that title, so yeah.
Okay, but the kind of mistakes you make, they are of a different nature. I would say that, for example, in 2010, I got involved in Chinese reverse mergers, and so there was just a bunch of frauds coming to the New York Stock Exchange back then, and smart guys like Jim Chanos, the famous short seller. He was on the short side of those trades, and I was on the long side. And so that's not where you want to be. You don't want to be on the opposite side of him. Yeah. And I saw these fascinating, beautiful looking numbers. Price earnings of 4 and growth rates of 20%, and it just didn't make sense. The stock should be trading a lot higher, but it wasn't, and so I got lured in, not doing enough due diligence on it. And it just turns out to be shell companies. There was actually at least for some of them. So there was this documentary called the Chinese Hustle, I think, or the China Hustle, or something like that. Coming out on Netflix, where they went deep on these Chinese mergers, and I saw one of the stocks that I lost 100% in it, and I just saw it featured in that film, and it was I took my hand to my eyes, because it was not pleasant to watch.
But what a great learning experience, right?
Yeah, for sure, because you want to do more due diligence when you've got burned.
So let's talk about the due diligence that goes involved in that, because a lot of times you can, companies are polished, right? Either they're just flat out frauds like some of these companies were, or they're really big promotes, and you'll experience that a lot in the world of natural resource investing and biotech and small cap tech. But there's a lot of promoters out there. So talk to listeners about what your due diligence process is.
You don't want to rely too much on their investor presentations. That's one thing, because those are always, best case scenario, blue sky scenario kind of stuff. And so I find the 10Ks and the 10Qs, the quarterly reports, to be of much greater value. To read them from the first letter to the last.
Yeah.
Because in those, they have to disclose pretty much all the risks that they see. So you get a more realistic look of the risks involved. So that would probably be the number one thing I would say. Just read a lot of quarterly reports.
Yeah, I could not agree with you more. And again, if a company is fraudulent, they'll say whatever they want sometimes in the Qs, but they know there are consequences for those. But oftentimes, what I've found is it's like a blank canvas. Sometimes the Qs or the Ks or the proxies, right? They don't come out and give the bad news in there, but they give enough information where you can put the pieces together. And that's where you're kind of like stepping back and applying common sense to things, right? That's how I tend to interpret those. I take those for what they are. I search through them, and as you go on in investing, as people go on and learn more, just like I've learned so much from so many stupid mistakes I learned. But at the time, they weren't stupid mistakes. I didn't know better, right? So you make mistakes, and then you learn, and you keep that in your mental filing cabinet. And my gosh, you can really start piecing the puzzle together. Especially in the world of mining, right, where you can look at the promoters, and you can look at and there they give you the technical reports. So if it's a Canadian company, a National Instrument 43101, and it tells you the history of the project, it tells you the geography, it tells you the drilling that went into it. It tells you the grade and the cutoff grade and all of this stuff, right? And it could have been an old mine that was closed, and now they're going to be reopening it. And there's a new report that was issued,
and that mine just keeps on recycling from company to company.
Yeah,
right?
and bingo, and it recycles, and you have to ask, well, was there a closure report associated with it? And what did anything change in the grades that they were looking at, right? So you got to piece stuff together. It's almost, what intrigued me early on about investing, and my first, my first half of my career was really deep dive short selling. And I have an accounting degree, but I certainly, there's in school where I went, there was no class that said, here's a financial statement, here's how to analyze one, and then here's how to really analyze one for the real world, right? It's more like finance 101 type stuff. But in the real world, right, it's how to put the mosaic of information together. And for me, what I realized was it was almost like being a detective, because keep peeling the onion back, and you just, I like it a lot. I watch a lot of TV shows with crime dramas, and they always have this big board, and they put pictures of people up, and they put different things up, and they're trying to look at it and stare at it and try and move things around and put all these pieces together. And that's kind of like investing. That's how I found it early on, is take, what's that mosaic of information, and what does it lead to? So it's always intriguing for me. And I use for my picture on Twitter, I use the picture of Detective Columbo.
Right. Yeah, I love him too. Yeah.
Because I always found that fun.
It's a good metaphor for what you're doing, especially as a short seller.
Yeah.
Because I find that stocks that have a lot of short sellers, where the short selling percentage is high, I tend to stay away from it, because you always know that the short sellers, they do more due diligence than the longs.
Mhm.
So I'm really careful when I see high short.
Yeah, well, it's interesting, right? Because people think we use Tesla, for example, which is just unlike anything I've ever seen in terms of the polarizing nature of the CEO and the ravage, the bulls, the cult-like nature of them, and look, the bulls have been right from a stock price perspective, right? The stock keeps going up, and it's like Elon Musk is Teflon. Nothing can damage him. But when I see the shorts, and I do my own analysis in my newsletter, I have subscribers, and I don't share that on Twitter. I don't share that on the podcast, the work that I've done on it. But the people who subscribe see the work I've done on it, and to me, it just doesn't. None of it adds up. It doesn't make sense. But there are those on Twitter who are much more public about it, and these obviously by the stock price, their work is not come to fruition yet, but they get hammered by people, right, coming out and saying that shorts are going to get the burned. You don't know what you're talking about. You're working in your mom's basement. You have no idea. This is, I will tell you, having been a professional short seller for my whole career, this is by far some of the very best work I've ever seen done. And they don't have to. Some are professional investors, and I know who they are. And others are really smart people at home who get it, and they do tremendous work. And that's an example, though, where the stock could still go higher, right? And then there's sometimes, in a sector where people might own some stuff, they might look to short something that's more liquid, so that catches more short interest. But that's a really good observation, that the shorts do, because the risk is so much greater on the short side. If you're wrong, your risk is unlimited. As somebody, as you know about risk reward, right? You got to at least put the work behind it. It doesn't mean the stock price is going to reflect it. For me, the best lesson, Jacob, in that was the very first company I was assigned at my first hedge fund job was a for-profit education company, and I think we shorted it. We spent a couple of years doing it, and I'm going to get the but I think this, yes, and the stock I think was $8 or 10 or something like that. I forget. It was so long ago, but it was what all I did for basically 2 years was.
That must be excruciating, though.
Oh, it was.
Just sit and wait and wait and wait.
Oh, and the thing is the stock went from probably 8 into the mid 30s, and every step along the way, out in the field, talking to former employees, to former students, going through the enrollment process ourselves, looking at the financial statements, I knew this was fraud. I knew it was incorrect on this company. I knew it didn't make sense. Nothing made sense. But yet they put up a quarter and a quarter and a quarter, and they would blow the numbers out and blow the numbers out. And meanwhile, the stock, now I wasn't managing the position. The founder of the fund was the portfolio manager. I was doing the research, and there were a few other hedge funds doing it. Now, at that time, there was no Twitter or anything like that. So you were in your own little silo doing your work. But the more work that I did, and that a few people, the higher it went. And the more we were convinced, we knew that this was a house of cards. But the scoreboard every day was showing the stock going higher and higher and higher. And for me, it was, geez, even at that time, and the portfolio manager at the time was more dogmatic, and he was like, okay, I don't care. We're right, and that's it. And he sized it appropriately. And I think that's a lot of times, people don't realize on like a Tesla, it could hurt you, but if you got to size these things appropriately, and hopefully you size them appropriately. But it wasn't until the Attorney General sued them, the FBI raided them on this company, 20 something years ago, and then the stock eventually went to zero. But that was a couple of years. And for me, it was a great lesson in saying, okay, you do the work, but even that doesn't mean it's right. You got to step back and find that one catalyst. And sometimes you don't know when it's coming. It just comes out of left field. So it's hard. It is hard. But had we not done that work, we would have never had the conviction. We would have covered it 10 and 12 and 14 and 16. So it's tricky, and it's hard. Yeah.
And what I find interesting here in what you just said is you were waiting for years and
Yep.
years,
Yep.
and then the victory, when it comes, it's short, right? And it's all over, and okay, you won, but the victory was very short, and perhaps that's why it's sometimes difficult, or why people have difficulty in taking contrarian trades, because there's a lot of pain involved in the waiting, and then all of a sudden you make all the gains, but it's over so quickly, and the pain had dragged on and on and on. And
you did a post in May that caught my attention, and it was called "Get Paid for Being a Masochist," and you wrote about Contrarian Maritime,
right?
And that headline caught my attention because I smiled when I saw it, because I said, my entire career, I get paid for being a masochist. On the short side, you are getting pounded and pounded. And like on the short side, when you come up with an idea, it's at least for the way we do it, or I do it, you're settling in for the long haul. I can't figure out, okay, let's find a name they're going to we're going to do the work they're going to miss tomorrow or this quarter. Normally it's not obvious. So it could be 9 months or 12 months out that you're looking at that catalyst, right? And you're building a position and you're doing the work and you're scaling into it. But in the meantime, you're getting punched in the face most of the time if the stock has got some momentum behind it. And the same thing on the long side. When you are a contrarian investor, my goodness, right? You are just getting paid. Now, so let's talk about this. So why would somebody want to be a masochist?
Because it pays. So if you can take the pain, that's the problem. Many cannot take the pain. They want the immediate rewards, and usually stocks go up slowly. And if you're on the momentum side, the growth stocks, then you get mental rewards daily, pretty much.
Yeah.
Because it's more often than not it goes up, and when it comes down, it can be quite dramatic and hurt really bad. But at least those who were on the long side, they had a lot of mental comfort for a long time. But then
you nailed it. Yeah.
But in the end, yeah.
Well, what's funny about it is the funny part about it is, if you think about it, what gives me the comfort on doing it is everything comes down to risk, reward, and probabilities. So I'm willing to be a masochist and see red every day on that screen. Let's say it's on the long side. If I go into a position or a sector or a trade or a theme, and I say, okay, I have, I'm making up numbers. I have 30% downside, but I think I have 300% upside. My risk, my reward is 10x my risk. I'm willing to take that pain, right? And what I find is oftentimes, right, your goal, it's going to be realized quickly, but in the interim, you're sitting there going, ugh. And then that's where your conviction gets tested, because everyone says, well, how come the market doesn't see it? What makes you see it? Now, that's where in names that are, where I was just talking on the intro beforehand, in a market that is so much more followed, so many more eyeballs on it, it's hard to make that claim. Well, the market's missing it. That's for me, when I'm looking at the junk pile, it's easy. Not easy. Nothing's easy, but it's easier because there's less people paying attention and changes get missed. And that's when you get paid for being a masochist. And I thought, when I read that post, the headline caught me, and then it was about product tankers you were talking about, and I thought, wow, and I'm drawn to the tanker, excuse me, in the shipping industry, because there's such violent swings, and in your post, I thought it was great. You said the question is often the case with deep value cyclical situations where future demand is certain, if not if the market come back, but when. This is why patience is the mother of all edges in cyclical industries. And then you said the curious Chinese proverb states that patience is only possible from a place of strength, which from an investor's point of view can be interpreted as not depending on near-term gains and refraining from using leverage in cyclical stocks, a tremendous advantage, and never being forced to sell. And I thought, you got it. And as I'm reading that, I'm like, hey, wow, I don't know who he is, but this guy is good. He's sharp, professional investor. And when we started talking and you told me your background, I thought, wow, this is fascinating. So good stuff.
I'm glad that you picked up on it, because I kind of enjoyed writing those paragraphs.
Because, it captures everything, right?
Yeah.
And then you said the second magic ingredient is cultivating a tolerance for pain. And I'm going to read this. It's essential because the troughs are often outdrawn and longer than expected, and the upturn is often short and violent. So while the net result may be overperformance, in the end, deep value investors experience more defeats on a daily basis than momentum investors, which is why it's harder, right? And one gets paid. And man, if there are days my wife will say to me, what's wrong? Nothing, I'm fine. What's wrong? Why? You seem like you're a little grouchy, right? And this was when I was just doing short selling for years and years. And I said, well, how would you like it if every day you're right, you've done the work, but you're getting pounded? And we would laugh because you just kind of settle into that. But now I think you have to be wired that way. I'm wired to be right. You can't just say, I have a friend of mine. I saw him last night, and we were at one of our neighbors. Their daughter had a birthday, and we were there, and I saw him, and he is one of the nicest guys I've ever met in my life. And he is a financial advisor, and very good. He's more sales than he is advice, but he's been around 25 years, but a sweetheart of a guy and sharp, and he couldn't ever see the negative in anything, right? And it's he couldn't, when we talk about like uranium, he's just like, none of it makes sense to him, and he's very bright, but it's not how he's wired.
What doesn't make sense?
Well, what doesn't make sense to him is simply why the pain threshold. And now obviously in any deeply, it's not the pain threshold. It's why would you like something that's not working? And I explain risk reward. And again, he's not an analyst. He's not for him, he couldn't go to his clients and say, we're going to buy something that has, we might wait 12 or 18 months, which we've been waiting, and it's turning now. But that's not right. He's talking about good things that are, hey, they're working, and they're, look at this, and this is great, and everything's good, and all that stuff.
Momentum investing. It's
momentum investing. That's what he does. And again, bright, but not drilling down, not doing the analysis. So it's easier to read a headline and go with it, and it's just there. Where for me, I can't. And when the market turns down, he gets hammered, right? So it's just kind of the way it works. And I'm looking to say, okay, I'm willing to sit back and hang on for a while if I think my downside's limited. And it's a fascinating way to invest. And so tell us. Okay, so it's hammerinvesting.wordpress.com is your blog, and you are Hammer Investing at Hammer Investing on Twitter. Tell us, how often do you write stuff? What excites you? How do you get the word out there?
I write whenever I feel like it. So I write for my own amusement, and sometimes people pick up on it, and that's great. I chose the handle Hammer Investing because you want to go where things are not obvious. You want to do more than scratch the surface. You want to hit it to really uncover the truth about a situation. So whatever is in the media, it probably doesn't have much value because everybody knows it. If it's a headline in a newspaper, everybody knows it. Then there's no edge, and that's another thing about being a poker player. You learn that, okay, you don't sit in a game where you don't see an edge. Yeah. So when I sit and play someone, I would say heads up, specialist, so I played one-on-one. And if I didn't see a mistake within 20 or 30 hands, I would just say, this is not worth my while. I mean, I could compete, and it would probably be fun and interesting. But I'm there to make a living, and if we battle it out 12 hours in a row, and let's see, none of us had an advantage, then it would just be the poker side who got the spoils, and perhaps he was the better player, or she, and yeah. So I just wanted to, just every day when you go to work, so to speak, as a poker player, I had a losing. I lost 47% of the days that I played. So most people would be pretty uncomfortable with 40% of this percent of the time you go home poorer than you were before. So I was pretty envious of people who had jobs like a gardener, where you see stuff grow every day, just a little bit every day. So I was like, oh my God, so envious of
Jacob, do you know
that.
how many times over 20 years, and especially the first half of my career, I would talk to my wife and I would say, I should have been a carpenter. And she'd say, why? And I would say, because you know what?
You see the results.
Every day you walk there and you build something and you walk away. I said, here, I do the work, and I say, wow, look at this. I found a piece of the puzzle, and the stock was up 5% and I was short it.
Yeah.
But you're right. But then when that reward comes, it is so short-lived. But if you've scaled it right, you say, oh, okay. And that's what on our short on that for-profit company way back in the 90s, it was, you can only make 100%, but it didn't go straight up every day. And we traded around it a little, and as it went up, we got bigger. And so, but you do, as you're saying it, it so resonates with me what you're talking about.
And so how you, exactly like you said, that the way to protect yourself in those situations is position sizing.
Yeah.
Because that is another thing. One of my more recent mistakes was actually, sizing too hard on a high risk, high reward situation. So still to this day, it was a stock that failed, and still to this day, I think that the risk reward was good. But I got hurt unnecessarily by sizing so much. So when risk is high, then just cannot size as hard as you can when the downside is more protected.
And I like the probability weight too. Sometimes I don't have one method. I don't just say, okay, I want this type of company, and because I could see the advantages and disadvantages of others. But if I think something has 5x or 8x or 10x upside, right? And those are rare, but if you think that, then I have to say, well, what's the probability that happens? And it might be much lower than something that has much less of a risk reward. But if that's the case, then I make it a much smaller position. And it's right. So probability weighting comes in so important when you're managing a portfolio. It is. And God, when I was playing the poker, I may play again. Maybe I'll play with my 12-year-old, and I'll get.
It's like you have a handle on it.
Yeah. Well, I'm not sure. Like I said, it was beginner's luck, but my 12-year-old probably beat me pretty good at it because he's got a good gut. But it's such a fascinating thing, and I love the fact that you're. I love that we can bring you on here and talk to somebody who has a really good investing mind that is worth my time reading, and I think is really fascinating. And like me, you didn't go to Harvard and get your MBA in finance because you don't need that. It doesn't hurt, but it doesn't. But it's pretty cool. So okay, so what in the next few minutes, what excites you now? What's interesting to you?
Well, I do look at shipping, like you mentioned. There's the tanker segment. Also look at LPG, liquefied petroleum gas, which is also shipping, and car carriers. I also look at that. But so what's interesting about that space is that there's been massive oversupply for a long time, and now that is coming down because they are hurting, and they're not receiving the prices that they need. So they need to cut their well, there's some new regulation coming on in 2020 where they need their vessels upgraded, and so they need to consider whether to do this expensive upgrade or simply take out some of the older ships. And a lot of those older ships or vessels are being taken out of the market now. And so prices will, I think, almost certainly will come back to more profitable or to profitable levels again. So yeah, again, a cyclical situation, and I'm also very attracted to those for the reasons we spoke about the pain. That if you've developed a tolerance for it, then I think there's more value to be had.
We are in the same camp on that. That is for certain. Well, that's great. Yeah, and I find this, and the cyclical ones, when they in these deep cyclical industries, that's why you see the price movements when it changes at that inflection point are so violent.
Yeah. And that's why you need to get in early, because you cannot wait for the thing to turn. And because many people say to me, okay, Jacob, tell me when it's starting to turn. But by then it's often too late.
Absolutely. Absolutely.
So I'm like, and they want to sit there and wait for me to give, to turn on the button. And
yep. So it's like, okay, so let me get this straight. Let me get this straight. So you want me to absorb all the pain and just let you know when not to absorb it. It doesn't work that way. It's like, right, you got to be in there and try and you just got to be there is what you have to be. Well, Jacob, this was great. I really enjoyed speaking with you. It was good. I always enjoy our back and forth on Twitter private message. So it's good to be able to chat with you. And the website is hammerinvesting.wordpress.com, and you are at hammerinvesting on Twitter. That's great. Well, I'm going to have you back, and next time you come back, we're going to walk through a theme together, an investing theme.
All right, that sounds great, Mike.
Well, it was
good to talk. Finally,
it was great finally speaking, and I look forward to staying in touch.
Yeah, me too.
Okay,
thank you, Mike.
Hope you enjoyed listening to Jacob. I really enjoyed speaking with him. His when I originally read his "Get Paid for Being a Masochist," I thought, who is this guy? I really like this. And then as I read it, and then one thing led to another, and I thought, you know what? We DM'd a bunch, or PM'd, whatever it's called, private message on Twitter, and I thought it'd be interesting to hear from somebody who has a contrarian view and was not. He's doing it now, making a living, but he didn't grow up as a professional investor. So I wanted to share that with you. Anyway, I hope you enjoyed it. I'll take write-ins. I'm looking for new teams. I am open. I've divorced the New York Jets. I wrote to my friends. I think I said earlier in the podcast, I'm getting a divorce from the Jets, and I'm looking for a new team. So write in, let me know, and I'm open.
I just want to let you know that I am the co-founder and chief investment officer at Sachem Cove Partners, LLC. And due to industry regulations, I don't discuss any of Sachem Cove's funds on this podcast. And all the opinions expressed by the podcast participants are solely their own opinions and do not necessarily reflect the opinion of Sachem Cove or its affiliates. And this podcast is for informational purposes only, and it should not be relied upon as the basis for investment decisions. Clients and or affiliates of Sachem Cove Partners may maintain positions in securities discussed on this podcast.
Thanks. Take care.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.